Today, how real is the falling headline US inflation? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, the US markets jumped on the glimmer of good news the day before the Fed announces the next rate decision, thanks to the latest CPI data. As a result, stocks and bonds rallied after the report as investors boosted bets that the Fed will pause its tightening cycle early next year. So-called core inflation, which excludes food and energy, rose just 0.2% in November. That's the smallest monthly advance since August 2021. That said, annual headline inflation is still running above 7%, so it's far too soon for the Fed to let the foot off the gas as it tries to get inflation under control. Policymakers are widely expected to downshift to a 50 basis point hike on Wednesday, but Chair Jerome Powell will likely communicate that rates will need to remain restrictive well into next year to further cool prices and to get inflation back to target. The headline CPI rate slowed from 7.7% a year ago to 7.1% in October as price pressures for all major categories slowed. Unsurprisingly, a 2% monthly decline in gasoline prices pushed energy inflation down further to 13.1% year over year. And CPI for food also slowed to 10.1% from a year ago in November, and that rate itself is still, of course, very elevated compared to an average rate of just 1.6% over the 5 years before the pandemic. But improvement in global supply chain conditions, as well as lower food commodity prices, should see the positive trend persist into 2023. Easing food and energy inflation means an increasingly larger share of inflation in the US, just under a third of the headline year-over-year growth rate in November, was driven by surging rent costs. Most of that, however, reflects increases in market rents over the last year, feeding through to leases with a lag. Those pressures will start to moderate soon, given a slowdown in current market rents since this past summer. Even accounting for the outsized monthly gain in rents, which was up 0.8%, broadening moderation in price pressures across other non-food and energy items meant that core inflation slowed again in November. The 0.2% monthly increase in CPI, excluding food and energy, was markedly slower than the 0.5% average pace year to date, and that's also the smallest since August 2021. Notable moderation was again seen in new and used cars, as well as other durable goods. And growth in services CPI, excluding rents, that's a measure Fed Chair Powell has identified as an important indicator for underlying inflation trends, slowed to an annualized 3.2% over the last 3 months, after peaking as high as 12.8% in June. But there are still some funnies in the numbers, maybe even a Numberwang. For example, due to a massive mega adjustment, the CPI for health insurance plunged 4.3% in November from October, having already plunged by 4% in October from September. This was by far the biggest month-to-month plunge in the data, going right the way back to 2005. These 2 months in a row of mega adjustments reduced the year-over-year rate of the CPI for health insurance from 28% in September to 13.5% in November. Those adjustments have occurred before, but never as large as this. What this adjustment means is that health insurance CPI was overstated for the 12 months through to September and is now being understated and will be understated for 10 more months to rectify the overstatement. And the core CPI, which excludes the volatile food and energy products, rose 0.2% for the month, thanks in part to that massive health insurance adjustment. And again, the CPI for rent for shelter accounts for 32.3% of total CPI. It tracks housing costs as a service, not as an investment asset, and is based on rents. Rent of primary residence accounts for 7.4% of total CPI, and that spiked by 0.8% for the month and by 7.9% year over year, and was the highest since 1982. It tracks actual rents paid by a large panel of tenants, including in rent-controlled apartments. Other rent indices, including Zillow's rent index, are based on asking rents, which are the advertised rents that landlords want to charge future tenants. A landlord may lower the asking rent if potential tenants are not biting. Owners' equivalent rent of residentials, which accounts for 24% of total CPI, jumped by 0.7% for the month and by 7.1% year over year. And that tracks the cost of home ownership as a service based on what a large panel of homeowners report their home would rent for. And the CPI for food at home, that's food bought at stores and markets, jumped by 0.5% for the month and 10.6% over the year, lower but still very high. So all up, price growth has further to fall before reaching the Fed's 2% target, and consumer demand has been more resilient, adding some tailwinds to inflation trends. Still, higher interest rates will cut into household purchasing power in the year ahead, and so it's likely that inflation will continue to creep broadly lower. And overall, a smaller 50 basis point hike is expected for the Fed's meeting tomorrow, to be followed by another 50 basis points over the first quarter next year, before possibly the Fed feels comfortable to pause the current cycle and then reassess. Assuming further moderation in inflation ahead, the November report provides more confidence that the Fed may only need to tap the brakes lightly in the new year to cap this tightening cycle, Sal Gattari, chief economist at BMO Capital Markets, said. If so, it will go some ways to increasing the odds of a soft landing. The half-point move for this week was in fact well telegraphed before the CPI report. Traders are now leaning toward an even smaller 25 basis point increase for February's meeting, and they also see a lower peak in the Fed funds rate. The report caps off a year in which inflation surged to 9.1%, that's the highest in 40 years, propelled by persistent mismatches in supply and demand and compounded by Russia's war in Ukraine. Economists expect supply chains to continue to improve while consumer spending and the labour market soften, which would ease the pressure on prices. Some of the cooling last month came from energy prices, particularly gasoline and electricity, and medical care services dropped by the most ever on a monthly basis, and travel categories like airfares and hotels also declined. Shelter was by far the biggest contributor to the overall CPI, and even though real-time measures show asking rents are cooling, it's taking some time to filter through to the government data as renters renew their leases or move on to a new place. Once that happens, then I think we can more convincingly say that the darkest age for inflation is behind us, Cautionary said in an interview. The November CPI report was a second month of good news on inflation, and December's report will likely bring a third. And while it's unclear if non-shelter core prices are slowing meaningfully, the string of soft reports should embolden the growing contingent inside and outside the Fed, calling for a pause in rate hikes eventually. The Fed may be concerned by resurgent wages, which increased 0.5% in November from a month earlier, but were still down 1.9% from a year ago, according to another report. Policymakers have emphasised the importance of the labour market and earnings in particular in determining the trajectory of inflation. Higher wages can lead to higher consumer prices because businesses tend to pass at least part of the added expenses onto their clients. Even as core inflation slows due to easing supply chains and a normalised mix of consumer demand, it's hard to imagine inflation returning to the central bank's 2% target with nominal wage growth running at 5%, Wells Fargo said. More encouraging for officials is the slowdown in core services, excluding shelter, a type of category that Powell has stressed in determining the path of price pressures, though based on a separate gauge of inflation. And while the drop in some categories like used cars and medical care may exaggerate the softness in core CPI, the overall direction still points to a more sustained deacceleration, a trend many economists see extending into next year. This is not an outlier. Omar Sharif, founder of Inflation Insights LLC, said in the note that this looks like a fairly broad-based slowdown in core inflation. Now, in fact, the Dow cut the bulk of its gains on Tuesday as investors weighed up the data, showing easing inflation pressures for the second straight month, just a day ahead of the Federal Reserve's interest rate decision. The Dow Jones Industrial Average gained 0.3%, though it had been up more than 700 points at the highs of the day. The Nasdaq rose 1%, and the S&P 500 rose 0.7%. Expectations that the Fed could pause sooner rather than later pushed Treasury yields sharply lower, sparking a Meta-led surge in big tech. Meta Platforms gained more than 4% after Goldman Sachs flagged the social media giant as a top pick, saying most of the bad news about the firm's core social media business and concerns about its hefty investments in the metaverse is increasingly priced into the shares. Alphabet rose 2%, while Apple and Microsoft ended in the green, with the latter up more than 1%. Energy added to gains from a day earlier as oil prices were driven higher by ongoing supply constraints amid the closure of the Keystone Pipeline supplying Canadian heavy crude to the US Gulf Coast of Mexico. Halliburton rallied more than 7%, while APA Corporation and Schlumberger were up about 4%. And in healthcare, meanwhile, Moderna jumped 20% after the drug maker announced positive results from its experimental skin cancer treatment. Pfizer, meanwhile, closed up nearly 2% as Goldman Sachs upgraded its rating on the stock to buy from neutral on expectation the firm's RSV migraine and sickle cell disease drugs will drive growth in 2023. The move higher in the broader market comes as some continue to warn of a downturn next year, driven by a deterioration in corporate earnings as margins come under pressure from a weaker consumer amid the impact of higher interest rates. As earnings projections deteriorate and the lagged effects of the Fed's actions begin to set in a more concrete way, I think markets will turn down, Philip Towers, CEO and portfolio manager of Towers Asset Management, said. The numbers bolstered hopes that the Federal Reserve will be able to soften its guidance on Wednesday when Chair Jerome Powell announces what is expected to be a 50 basis point increase in the target range for the Fed funds. The S&P 500 futures rose and the dollar fell, along with benchmark Treasury bond yields as market participants moved to price in a lower trajectory for US interest rates going forward. Mike Consal, Director of Macroeconomic Research at the Roosevelt Institute, said that the report met all three of the key criteria that Powell has made preconditions for slowing the pace of monetary policy tightening: falling goods prices, a peak in house prices, and signs of cooling from services prices. All three happened, and happened again for the second month in a row, he said. The numbers contrast with the labour market report released 2 weeks ago, whose strength had hinted at stubborn inflationary pressure across the economy. In fact, the economy added 800,000 jobs in the last 3 months, giving little indication of the recession that many have said would follow this year's sharp increase in interest rates. This is the very definition of a soft landing, Powell articulated this year. Consal said, "It's there if the Fed pauses and lets these positive developments all play themselves out." While investors were actively discussing the Fed and the upcoming CPI report, Morgan Stanley is telling them that it's yesterday's news. Instead, investors should pay closer attention to the earnings risks, as estimates are, quote, far too high. However, Morgan Stanley told its clients to focus on the soft survey macro data, because this type of data tends to lead the economic and earnings data. The broker's top equity strategist reminded investors that the market was ignoring the Fed risk a year ago. Today, it is ignoring the earnings risk, with the equity premium at least 225 basis points for the S&P 500. This makes the risk-reward very unattractive given our forecast on earnings the next year, they wrote to clients over the weekend. The disconnect in pricing, the earnings recession, also occurred in 2008 when the market was slow to recognize upcoming earnings declines. The strategists see the S&P 500 plunging to 3,000 to 3,300 in the first quarter before recovering, and they add that this bear market rally is already running out of steam. We find it very challenging to argue for higher valuations at this point, and with our expectation of falling earnings estimates, that leaves little, if any, upside to broader equity markets from here. The bottom line, we think the CPI and Fed actions next week are unlikely to change the picture, they concluded. So there you have it. I think a pretty good summary of what's going on, and we'll be watching, of course, for the Fed tomorrow. But I must remind you again that the CPI numbers in the US are still being fudged quite dramatically, and of course, Numberwangs exist wherever you look. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.